Welcome back to Arizona Real Estate Matters, brought to you by Empire Title Agency. Our guest today is Brian Bailey. He's with C2 Financial. And, Brian, normally I introduce guests and say, tell us a little bit about yourself. But you were just on a few weeks ago, and we talked mainly in your 15-minute segment about forward mortgages more so than anything else. But I wanted to bring you back because something that's near and dear to my heart in the industry is reverse mortgages. And you do reverse mortgages. So today we're going to spend the whole show, the rest of the show, talking reverse mortgages, which you do as well.
Yes.
And the advantages of them. I've said numerous times on the air and in private to people that, as soon as I turn 62, I'm going to be looking into doing a reverse mortgage because of the advantages of them. And so I wanted to bring you on today to spend this time because I wanted to devote more time to what I normally do with loan officers as far as mortgages are concerned, because the 15-minute segment that we usually have a loan officer on is not really enough time to really delve in deep on these reverses.
That's correct.
And so that's what we're going to spend our today talking about is the reverses. So let me ask you. So I'm going to break this down real simple for people because for the longest time, reverse mortgages got, and I think that's part of the stigma right now, believe it or not, even though it's been years since they were considered toxic, I guess is probably a good word for it. I think the 80s, the government stepped in and decided to do reverse mortgages and make them FHA insured, correct?
Yeah, that's where you came into the creation of the reverse mortgage and then a lot of regulatory correction for it, kind of like what you're saying with the correction of the market. There's a correction needed to be done to fine-tune the product and to give to a certain level of insurance and protection for the seniors that they're not being taken advantage of and such.
Because that was one of the stigmas of reverses years ago was that, yeah, people were taken advantage of. I mean, things got pretty ugly with some of these reverses, the way they were set up.
Yeah, and even today, you still have folks like Dave Ramsey who are very big opponents of the reverse mortgage, and I would challenge that doesn't fully understand them because in one of his segments, they bring on a lady who's talking about how she was losing her house. The bank was stealing her house from her. And then when you look at peel back the onion, you see that she never made her tax payments. Mm-hmm. So someone, somewhere, somehow, the ball was dropped in making sure she understood that she was still responsible for her property taxes and her homeowner's insurance. The payment that's not being made is the principal and the interest. Mm-hmm. And so this is the really important part. And what I run into a lot is a loan officer can do a reverse. But, finding somebody who's specialized in it, that's why I went through and got the CRMP designation, which is a certified reverse mortgage professional through NRMLA. And NRMLA stands for National Reverse Mortgage Lenders Association. They're out there really pushing the high level ethics and morals to and education to this. And the CRMP designation I got, I strove for, I think I said in the last show, I was number 200 in the country. And so that's just a shy over 200 in the entire nation that have that designation.
That's
so
really good.
You can go to your average loan officer and they may or may not be able to do it depending on their lender, but to go to somebody who is actually certified in it and has taken that level of effort to educate themselves on it and specialize on it, because it is a complicated product. I'm not going to lie.
It is. No, it is. I do a lot of reverse mortgage escrows. I handle, of course, your business and a couple other lenders here in town who specialize in reverses, so I do them quite a bit. And to be honest with you, I'm educating myself as I go on how these things work. I mean, I know a lot more than the average person, not nearly as much as you do. And so I understand them and I know how they work. So I understand all the caveats as far as reverses are concerned. But there's so much to it that I'm always learning, and more all the time, every time I look at a loan package and that kind of thing, because they are a bit complicated, but at the same time, they're very safe. And they are not the loan of last resort. A lot that was one of the things they were considered was the loan of last resort. It's like, okay, we'll just do a reverse because we can't even afford to live, and that's one of the things, like especially right now you and I talked before the show. It's like we've had numerous times in our history as far as the economy is concerned, and that's not an American thing. I mean, the economy, every country in the world has an economy, and every country in the world has faced high or low inflation. I mean, it's a cyclical thing as far as money is concerned. And right now, we just have to be an elevated spot as far as inflation is concerned, and a lot of people are struggling. And there's a lot of mom and pops out there that if they qualify for a reverse, due to age and income and everything else, there's zero reason why they shouldn't be doing one, because they could have a $1,500 house payment that they're struggling to pay, along with food and everything else, and they're barely existing just on their house payment and food and electricity and whatever. By doing a reverse, they can get rid of that payment. And it's a great hedge against inflation, no matter when inflation rears its ugly head. Correct?
That's correct. And what you see is there's an effort to retrain the mindset of what debt is and whether it's good or bad.
There is good debt.
There is such thing as good debt, and this is one of them.
And that was one of the things. And I don't want to interrupt you, but Dave Ramsey has a lot of good things he talks about. But one of the things, and if I'm not mistaken, he does talk about good and bad debt. Look, you cannot be 100% debt free. It's almost impossible, to be that way. But one of the things I don't agree with is where he says, you need to pay your house off. And I don't agree with that. I think everybody should have some sort of mortgage on their home. And if you do have a free and clear home, look at a reverse mortgage if you qualify, because you have equity sitting in your home that is doing nothing.
Yeah. It's funny because the Journal of Financial Planning just did a recent study on regards to this topic, and they recently published it. But in there, the concept is no longer is all debt bad in retirement. That debt. Look, the reality is debt is not ideal, but it is also ideal that when you retire, you have $200 million. Mm-hmm. Life's not always ideal. Yeah, and, and somebody who has that level of a portfolio, that level, maybe reverse, wouldn't have that much of effect on them. They have other tax, breaks or different ways to hedge and such and do all that. Well, this isn't just a product for those types of affluent borrowers. This is for everyone. Sure. This is for the person who's struggling to pay the bills, as the example you're giving. This is for the mass affluent person who has, say, $500 to $1.5 million, and they're, looking at starting to pull from the Roth IRAs and receiving tax consequences, and they need to hedge against that. This is for all the way up to the high end. This is really a product for every senior.
Absolutely, and we're going to delve in deep on this stuff. But this is, there are tons of financial planners in the United States that are now embracing. What's that?
300,000.
300,000. They're embracing reverse mortgages. They're using it as part of their estate financial planning. A tool for them to say, look, guys, if you want to go forward and you want to be more financially sound and feel more comfortable, a reverse mortgage is one of the things you need to do. And if you've got CPAs and financial planners that are getting behind this saying this is something you have to do, there must be something good about it.
Yeah, and that's part of what I'm out there doing, not just educating the consumer, but educating the financial planners, the CPAs, the attorneys, divorce attorneys, and everyone else.
Everybody else, yeah. We're talking to Brian Bailey. He's with C2 Financial. We're talking reverse mortgages today. We are going to take a break. We'll be back after this. Welcome back to Arizona Real Estate Matters, brought to you by Empire Title Agency. Our guest today is Brian Bailey with C2 Financial, and we're talking reverse mortgages. Brian, we're gonna get in deep here as far as the advantages of it, but let's break it down to the bare basics. What is so as a reverse mortgage? What's the minimum age that you can be for a reverse?
For the standard HECM, the FHA insured HECM is 62 years of age for the borrower. You can have a non-borrowing spouse. So when you do look at tables, it goes all the way down to 18. But it does.
If you're 62 and you have an 18-year-old spouse, man or woman, God bless you.
Yeah, I guess.
But if you get 62-year-old men and women who have spouses that are a year or two younger, so it's not that both of them have to be 62.
Very important to understand because a lot of people miss that.
Sure.
And that's why I make sure to make a point. Like the youngest borrower has to be 62, but you can have a non-borrowing spouse, which now is protected meaning that once that 62-year-old borrower, let's say they pass away and their spouse is 55, that 55-year-old does not get kicked out of the house. They get to stay in that house. Everything was based off of their age, so they get to stay in the house for as long as they live, as long as it's their primary residence. And then, but it just shuts the equity line, and there's a couple other caveats to it, which again I could always explain.
And that was one of the things, is I said, a lot of people with reverse mortgages that, well, once you die, that the bank gets the house. No, that's not true. Again, guys, I've said this, and I'm going to say it till I'm blue in the face. Lenders do not want to own real estate. That's not how this works. It was proven in '08. It doesn't work right. It's not going to be that way in the future. I taught foreclosure classes way before '08, and the same thing applied. Lenders are in the business to lend money. Their job is to sell money to you and get a return on that money, not to own real estate. So when you have a reverse mortgage and the main borrower, the primary borrower, were to pass away, and the spouse can continue to live in the house, yes, like you said, some things do shut down, but they're still living in the house without a payment.
It's very simple. This is a mortgage.
Yes.
Like any other mortgage. Yes. You die, the house gets sold or however is liquidated, it's liquidated, and then the loan gets paid off, the heirs get the money, it's no different.
I'm starting my 40th year in the industry this year. And I don't believe to this day, a lot of people, have said to me, well, I don't own the house until I pay off my mortgage. That's not true.
Oh, my wife is adamant about that
way.
Because in South America, where she's from,
different.
That's the way it's thought.
And with a reverse mortgage, again, like Brian said, it's a mortgage. It's just a regular mortgage. It's the structure on how the mortgage either goes up or down, or if you have payments or not having payments, because that's the other thing. Okay, so at 62, you can get a reverse mortgage. Now, the reverse mortgage a lot of people know about is the one where you don't have a house payment. Okay, so I just want to break up the three. There's three different types out there, right? So there's the one where you borrow money against the house and you don't have a mortgage payment.
You don't have a principal and interest payment.
You don't have, you don't have a principal.
You still have to pay your taxes.
Your taxes and insurance, but that's not, you don't.
We have to be clear to say that, because sometimes that's, again, misinformation.
Yeah, but you pay those on your own. You don't pay them to the mortgage company.
That's correct.
Okay, so you don't pay anything back to the mortgage company. Then there's one out there where you can borrow money against your house, and you can actually have the mortgage company make payments to you, correct?
You have a term and a tenure. Okay. So tenure based on your age and based on whatever tables that they've however long they think that you're going to live, they'll take it and make it sure that you're receiving those payments for the duration of your life, based off of that equity line that's there.
So not only can you do a reverse mortgage and not have a payment, you can actually get income on that. Okay.
And you can have term payments. You can say, look, I'm going to do a reverse mortgage. I'm 62 years old. I don't want to pull Social Security until I'm 70. I need an extra $2,000 a month until then. And do an 8-year term and then base it off of that. Or you can just have it set up that it's just an equity line of credit there. It's just there to be pulled from as needed to help in whatever financial planning aspects you have, or major purchases that you want, grandchildren's college funds, whatever the case may
be. And you don't have to touch it either.
No.
And that's what's really cool about it. And I think, and that covers, I think, the three, because you jumped into the home equity credit line portion of it, which is you can set it up to where it's there and you can go get money if you need it, during your life. You still don't have a house payment, but you still have this equity credit line out there of maybe 100, 200, or 300, or 400,000, depending on the type of loan you're doing, that you can go grab if you need it for whatever reason. And you could utilize that money. Here's the cool thing about it, is that people don't understand, is when your equity, if you own your house free and clear, that's a great thing. Don't get me wrong. I mean, you got a $500,000 home sitting there, which means you're worth basically a $500,000 right off the bat. The problem is it's not doing anything for you.
No.
Okay, if you have a reverse mortgage and you do the equity credit line thing, now you've got the money sitting there. You could go get it, take that money and invest it maybe in some more real estate or some other investments and create more wealth on top of it.
Exactly.
Without having a monthly house payment.
Exactly.
That's crazy.
It is.
It sounds too good to be true. That's one of the things people say about reverse mortgages. It sounds too good to be true, but it's not. It is true. I do a lot of them. Brian does a lot of them. Other lenders do a lot of them. They're very, very safe. We're talking reverse mortgages with Brian Bailey with C2 Financial. We're going to take a break. We'll be back after this. Welcome back to Arizona Real Estate Matters, brought to you by Empire Title. We're talking to Brian Bailey at C2 Financial, and we're talking reverse mortgages today. Brian, so 62, there's three different types of, and we're just scratching the surface on this. I mean, Brian's going to give his phone number at the end of the segment here, and if you're interested in this, if you're 62 years old and you don't have a reverse mortgage, you should be interested in this. It doesn't cost anything to give Brian a call so he can talk to you and tell you exactly how it can benefit you. If you've got CPAs and financial planners all over the United States that are jumping on board with reverse mortgages and saying, this needs to be part of your financial plan going forward, this is something you need to do. So when Brian gives his phone number, make sure you write it down. Give him a call. If you don't have a reverse mortgage, at least one of you is 62 years old, and you own your home as your primary residence. So that's the other thing. Okay, so what's the loan limit on reverses, by the way?
Right now, it's let's just say $1,080,000.
Okay,
so that's
so up to $1,080,000 is considered non-jumbo
loan amount.
Yeah, loan amount.
Yes.
Okay, which in the FHA world or whatever, it's like 400 some odd thousand. You know what I mean? So there's a big disparity there as far as dollar amounts are concerned.
Yeah. So you're probably looking at somebody, say in the 70, younger 70s, that's hitting that 50% draw mark, that they say can have up to about like $2 million house and could get a loan around $1 million.
That's crazy.
Yeah.
And these are FHA insured, guys. These are safe FHA insured loans. All right. So 62 years old, three different ways of doing it. Let's talk about where you can put one of these reverse mortgages. Let's say you have an investment property in Arizona, but your primary residence is in Chicago. Can you do the one here in Arizona?
No.
Okay. So it's got to be on your primary residence.
Got to be your primary residence where you spend 6 months and 1 day at. Now, what a lot of people some of my clients do is they pull a reverse mortgage here on their primary property here in Arizona. They pull that money out, and then they go out and buy a house up north back home or close to where the children have moved, grandchildren are, whatever the case may be, buying an RV, whatever the case. And the awesome thing is they don't have to make that principal and interest payment here on this property, and then they just bought a cabin up or something up north, and they don't have to make a payment there because they paid cash. So now they got two properties appreciating in their values.
So I'm stammering a bit because it's amazing here. A lot of people think you do a reverse mortgage as far as just financing an existing property. But you can actually use a reverse to purchase, and we're going to talk about that. But the point being is that you have your primary residence here, you do a reverse mortgage, you pull some cash on it, you don't have a house payment, you take the cash you pulled out of your house here and you buy another property, and again, you've just built wealth and not having a PI payment, a principal and interest payment on either property, and now you own two pieces of real estate.
Exactly. Some are doing it for rental properties to help subsidize. Instead of pulling that reverse out and using those payments to subsidize, they're buying rental properties, fourplexes and such.
Which create income.
So
now you have no house payment on your primary residence. You have no house payment possibly on your rental properties, and you have income coming in on those.
Yeah.
A lot of people might say, well, it's risky to do something like that. Guys, in the last 30 years, Arizona realized an appreciation rate on real estate over a 30-year period of 463%. Yeah, you may have some dips in the market from time to time, but over a 30-year period in the state of Arizona, it's documented 463% is how much money people made on their homes over a 30-year period. If all you have is your primary residence and you want to get into this and you think, well, I'm retired, I just don't have the money to do that, this could free up that money.
Yeah, definitely.
That's what's crazy about it. Okay, so if you have a primary residence, you have an existing mortgage, you can refinance from your existing mortgage into a reverse. If you have a current reverse mortgage, you can do a HECM to HECM. And guys, we call them reverses, but they're actually called HECMs, which stands for home equity conversion mortgage. So if you have a current HECM loan or a reverse mortgage, you can refinance out of that and into a new one.
Yes, to lower there's certain safeguards there. Again, they're not looking for any kind of predatory lending. They want to make sure that there's a definite benefit to the borrower that for that, a lower rate, or the value of the property has gone up substantially, that they're going to receive that much more of a claim against their max claim amount. There's various aspects to it that they have to look at. But if it makes sense, it makes sense. If it doesn't, that's what we're here to tell you. It doesn't make sense. Sit tight.
Absolutely, absolutely.
The other thing that's important, and I just want to chime in here, is back in my day, in the beginning of my financial career, I was working at a larger bank. Let's just say I rode a stagecoach to work. And I was doing a lot of HELOCs. It was when everything was booming, 2005, 2006 range, right before the crash happened, and it was booming. And I was doing HELOCs, like large HELOCs for people so they could fund their business and everything else. Then the crash started happening. Then those HELOCs, boom, shut down.
Shut them off.
And people were running their businesses off them and then coming into me, and I'm like, I don't know what to tell you.
Can't
The
access
bank
it
has
anymore. Yes.
the bank has that because of the market shift. They can shut it down.
Yeah.
That does not happen on a HECM. Once that line of credit is established and that line of credit has a growth rate on top of it,
It
so
gets
if
bigger.
you leave it, it actually grows, but it never goes away. It's FHA insured, not FDIC insured.
Yeah.
But what if you could put your money somewhere and have that money and growing, and it's insured that you can always have access to it for the rest of your life?
And if your equity credit line grows as the house appreciates, you may have had, let's say today when you do your reverse, you got a $300,000 equity credit line. In a few years, you could be up to $500,000. You know what I'm saying? So now you have even more money available to you. You can use your home equity and put it to work for you.
Exactly.
As opposed to just sitting there and saying, well, my house is free and clear. This is great. Yeah, but you have $500,000 sitting there doing nothing.
Yeah. Well, it was back in 1950 that I think that they had developed the financial planning aspect of diversification and such, and they started putting that into play. And it's just recently that in the Journal of Financial Planning that they changed it, or that they're looking into it, and they did a huge study about 10,000 Monte Carlo tests on this different aspect of it. And I can't really explain it to you right now over the radio because it's all numbers. It's hard to look at, but it's essentially everything. There's a paradigm shift. There's a market shift going. And Max Planck, a physicist who won the Nobel Prize for discovering that little thing called quantum theory.
Yeah, we've heard of that.
Yeah, he's quoted as saying, "A new scientific truth does not triumph by convincing its opponents and making them see the light, but rather because its opponents eventually die and a new generation grows up that is familiar with it." But we don't have time for you to wait and die. You don't have to wait and die. You know what I mean?
Yeah.
Just be open to the idea. Let's look at the numbers. Let's get trusted people in. If it's the children, if it's the financial planners,
sure.
it's the CPAs. Let's everybody sit at a table and make sure and vet it.
And
it's
pencil
being
it.
vetted.
Yeah. Pencil
big
it out
time.
and say, okay, this is how it works. This is where you're going to be at from point A to point B. This is where you're going to get it. You're going to be at. And if it doesn't make sense, you're not going to do the deal.
Yeah, because essentially what happens in these journals, there's one journal of financial planning. There's like thousands of journals in the medical industry. What happens is when you have a theory and you put that theory forward, and that theory, basically all your peers do everything they can to tear it apart. They do whatever they can to disprove
absolutely.
it. And if they can't, they publish it. And it was on the cover of the December 2021 journal. They
Wow.
do maybe one a month, if any, and that was
That
in
was on the
December
cover.
2021.
That's crazy.
So there's a shift.
Yeah. No, absolutely. People need to be thinking that way.
Yeah.
We're talking to Brian Bailey with C2 Financial, and we're talking reverse mortgages. Now, your mom took advantage of this. I wanted to share that story because that's, if you're doing a loan for your own mother, it must be okay.
You better. Maybe there's a few folks out there that wouldn't care, But no, my mother. I'm from northern Minnesota, and in moving here, I got stationed out of Luke Air Force Base. I came out this way. Finally, years later, back in 2018, my mom wanted to move out here. She cut hair. She did everything. She wasn't gonna. She's at that age, 70. Approximately 70, that she wanted to move out this direction, but she wasn't going to have that income anymore. And we've always been a house of self-employed business owners and such, so there wasn't a big Social Security to be taken either, all right? So when her coming out here, the reverse, she sold her lakeshore property up in Minnesota and bought a house here cash, okay? And then we did a reverse on it. I could have done a reverse for purchase, but we didn't just because of timing aspect. So just full disclosure. Now in that, it allowed her to get settled, get situated. She did a couple draws on it for some different things, different fix-ups that she wanted to do on the property. She ended up getting a job and going back to work, and I think with greeting cards company, paid that stuff back. Then all of a sudden, she said, I don't know if it had something to do with my wife and I going full-time RV or what, but she decided, like, you know what, I miss Minnesota. Yeah. And you take the girl out of Minnesota, but you can't take Minnesota out of the girl. And she moved back. And that was this last September. And so we moved her back, and that reverse mortgage allowed her to make a big draw. She bought the house in Minnesota cash and then sold the house here in Minnesota, kind of opposite of what we did the first time.
Gotcha.
So, here's a situation where a reverse mortgage allowed access both times and provided an opportunity that she didn't have before. So the thing is don't worry about being sold. Like, ask all the questions, ask all the hard questions. Sure. Beat me up.
Yeah,
beat
absolutely.
me up.
Absolutely.
I'm a big boy. I can take it. Beat me up and let's go through it and make sure, if whatever your situation is, the big thing to remember here is it does require equity in your property. Mm-hmm. And a lot of the baby boomers, this generation that we are talking about, and now starting to get into the I'm an X-gen and I'm at 50.
Closer, yep.
I'm getting there, I'm scratching at that door. But I have, we have our parents and stuff, and we need to look at that and find out what's best for them, and not so much concerned about what the market is. I mean, turn on CNN and tell me how the real estate market's doing. You're saying there's not going to be a crash.
Yeah, no,
I don't think that's what CNN's saying.
And it's not just them; it's every media outlet. I mean, I read a lot of stuff in preparation for the show, and just knowing what's happening, and whether it be CNN or Fox News or any of the major mainstream national media outlets or their websites, and even the local ones. I read an article yesterday on a local media website that they were interviewing a real estate agent, and in there, and this was an article from 2 days ago, okay, that was published 2 days ago, and the real estate agent, I'm not going to name names or anything like that, was talking about how at the beginning of 2022 rates were in like 3.1%, and now they're 7%. This was published 2 days ago, and then this real estate agent is saying the mortgage rates are 7%. And I'm like,
they need to call me because I can get them a much better rate than that.
You can get down in the 5s right now. I mean, that's the crazy thing about all this, is that you have to really be careful about what you read and what you see, no matter where it is. And this is what we talk about. If you want to know what's going on in the industry, you talk to the people who have boots on the ground, people like Brian, when it comes to these reverse mortgages. We're going to run out of time, but real quickly, you don't just need to do a HECM to refinance or finance your existing property. You can actually use a HECM loan or reverse mortgage to purchase a home. And the big thing about this is a lot of people, when they get to a certain age, are like, well, we have to downsize. By using a HECM to purchase, you may not have to downsize. That's what's the cool thing about it, is it gives you more purchasing power.
Exactly. I mean, we have folks that are moving in from California, and they're selling their homes over there, and they're coming over here, but they'll do a reverse for purchase. Just means they put a larger down payment down. That's all it is. It's the only difference. And then they take that equity, instead of putting all that money in the house and paying cash for that house here, they're actually taking that and redirecting it back to their portfolios and maximizing that cash on hand.
So a lot of people, what they'll do, a lot of times, let's say they're from like Oregon and Washington and California, notorious people were selling thear homes there over the last couple of years, and they were making so much money, they were coming down here and paying cash for houses down here. That's a problem, in my opinion, because now all their money is tied up in their house.
Exactly. When
if you're of 62, you can use a HECM for purchase, and you don't have to use all that money. You use some of the money. You do a HECM for purchase to buy the property. Now you don't have a house payment, and you have money to reinvest. Brian, what's your phone number?
My phone number is 480-420-7252, and we should have... by the airing of the show, the website should be live, and it's reversefinancial.com. My forward side is myloanbuddy.net, but the reverse side, what we're talking about today, is reversefinancial.com, and that should be live this Sunday.
If you're 62 years old, you own a home, primary residence, and you don't have a reverse mortgage, you need one. You need to call Brian Bailey. Brian, thank you so much for being on the show.
Thank you, Phil. Thanks for having me again.
Another great show, and we'll talk to you guys next week.